Hey guys, welcome once again to this new trading video. My name is Edreds and I'll be taking you through this module 4 of our series on the complete course on trading. All right, so in today's lesson, we shall look at fair value gaps and inverse fair value gaps. Very key and very important core lesson when you are learning how to trade and to read price. So, what is a fair value gap? We are saying a fair value gap is a price imbalance created when price moves aggressively in one direction, leaving an area where relatively little trading occurred. The easiest way to identify a traditional three-candle fair value gap is, in this case, for a bullish scenario, you mark the lowest candle as your number one, then the following candle, you mark it as your number two, and the third candle as your number three. So the space between the this top wick, and the bottom wick of the third candle is what we call the fair value gap. I repeat, you mark the first candle, you mark the second candle, and you mark the third candle. The top of the first candle and the wick of the third candle, you identify the space in between them. You can see this and this, they don't have where they meet. So the space in between is what we call the fair value gap. And then for this case, for example, in the financial markets, this is a typical example from the markets. Why can't we consider this to be our fair value gap? Because if you see 1, 2, 3, there is no space in between these candles here. There's no space in between these candles here. But let's look at this. 1, 2, 3. There's no space. But now let's look at 1, 2, 3. You can see that the wick, top wick of this candle and the bottom wick of this candle here, they have a space. Okay, there is a space. As you can see, it is marked. So this is a fair value gap. So what happens when price returns back into that space? It reacts. You can see it is rejecting to go through it. Okay, because it's a sensitive area. So when this happens on a key level or a key zone in a discounted area, that's what I mean, which we shall look at later on in our other lessons, price becomes so important and it gives us key information. Okay, so identifying the things is very important because they help you to learn how to read price. So the color of the candles meaning doesn't matter in this case, and what matters most is the fair value gap, how it was created. You can see these are green, these are blue, but they are all bullish candles. If you don't understand how to identify a bullish market, go back to our lesson 3. You learn how to identify a bullish market and a bearish market. Okay, so for a bearish scenario, let's look at it. So for a bearish scenario, what happens is you mark the candle, which is 1, 2, 3. Okay, so the bottom wick of the first candle and the top wick of the third candle, they should not meet. And the space in between the bottom wick of the first candle and the top wick of the third candle is what we call the fair value gap. And just like I told you, the color does not matter, but the direction of the market does. So what happens here is that now, again, what we have here, we have 1, 2, 3. The first candle, second candle, and the third candle. What is there? The space in between. The space between the first candle and the third candle. This middle space is what you call the fair value gap. 1, 2, 3. These, they don't have a space, so we don't consider it a fair value gap. You can play back 2 more times, like 2 or 3, to understand it very well. We shall go, however, to the charts to see. So why does an FVG matter? Okay, or a fair value gap matter? Why does a fair value gap matter? Don't think there is a gap, therefore price must come back. Instead, think fair value gap equals to evidence of aggressive order flow or displacement. Okay, think it in a way that when you see a fair value gap, there was an aggressive move. The second candle creates this aggressive move. Okay, there was aggressive move. Okay, the second and the third candle shows that there was an aggressive move without looking behind. Because if it was not aggressive, we could see again this candle was weak, touching this week. So because they don't touch, we consider it to be a displacement or aggressive. So if you look back at our lesson in the CISTs, we normally say we mark the body closure of a candle above. So with the knowledge on CISTs, okay, and change of character, you know that price displaces, okay, it moves aggressively without turning back for that moment. Okay, so that's how you should think in this scenario, that it's an evidence that price moved aggressively or displaced. Okay, the important information is not simply the empty space. The important information is what caused the fair value gap. Okay, usually liquidity, displacement, fair value gap, retracement, possible continuation. This is how it moves. Supposed to be liquidity sweep. After sweeping liquidity, we move aggressively. We shall look at liquidity during our lesson on liquidity. It should be like model 7 or lesson 7 if not 8. So we sweep liquidity. After sweeping liquidity, we move aggressively. After moving aggressively, or displacing, which is them as moving aggressively, we create the fair value gap, and then price retraces or comes back into the fair value gap, and then I will expect to take trades within the fair value gap and continue to the direction where price was going. Okay, so this is the thing here. This is how it's supposed to be. Therefore, an FVG is often more useful as a location for reaction than a standalone trading signal. So you cannot say, now for me, as long as I see FVG price coming into it, I'm going to place buy or sell. No, no. You're supposed to handle it alongside other things. It's not a standalone signal. It's an entry. In fact, for me, I use it as an entry or point of interest or key zone, but not as a standalone signal, though we shall look at all those things later on when we are putting everything together, we shall learn in this course. Okay, so fair value gap and displacement, right? So this is one of the most important advanced concepts. So it literally in this course you're supposed to stop here. Okay, but I want us to go a little bit deeper. Okay, so this is one of the most what important advanced concept. Not every tiny imbalance deserves equal attention. Get my point? Okay, a fair value gap that happens in trending, but not all of them are the same. Later on, you will see these things when you start doing your own analysis. That it doesn't even respect all trading. All fair value gap. There are some, and we shall see the characteristics of the strong one and the weak one. Let's take a look at this. Okay, we are saying a stronger fair value gap, stronger displacement, large bodied candles, faster movement, break of structure, clear rejection of an opposing area, liquidity taken before the move. Okay, so what happens here? All right, you can see price swept here a low. This is a low. This is a low here. And then what happened? We moved off aggressively, leaving this break of structure here, and then moving higher to the opposing direction. Don't mind about this. We are going to look at the charts between the weak and the strong one. So, but this is just an example. But then the weak one, small candles. You see, these candles are very small, tiny. They are tiny. You see, this is a fair value gap. But look at the candles. They are tiny and they are very congested within a choppy market. Choppy price action. If you refer to our lesson on the types of markets under market structure, the previous lesson, lesson 3, types of markets, consolidating market. This is a consolidating market or choppy market. No meaningful displacement. There is no key. What? Why? Yes, we took our liquidity, but you look at the move. It did not move as expected. Okay. No structure significance. Right. So the quality of the FVG depends heavily on the quality of the move that created it. We shall look at that on the chart. I want you, when you go on the chart, you should be having this bit of knowledge so that when I point at something, you know what I'm talking about. So there are what we call the weak fair value gap and the strong fair value gaps. Okay. So FVG does not mean automatically an entry. Okay, like I told you. Price touch FVG, then you buy or sell. No, don't do that. It will be cooked. Okay. Before the FVG, was liquidity taken? These are the things you should ask yourself. For example, previous low, previous high, equal highs. We shall look at these types of liquidity when you're looking at the liquidity as a complete lesson. Okay. So did the price take out the previous high or the previous low, session high or session low? All right. So these are the things you ask yourself before validating an FVG or a fair value gap. Okay. During the fair value gap, was there displacement? After the fair value gap, what is price doing when it returns? Okay. Is it respecting the fair value gap? Is it trading deeply through it? Is it showing some sort of rejection? Is it inducing people when it is inside? It on the lower time frame. We shall look at that later. Is it breaking structure? Moving through it aggressively, what is it doing? This gives you the context of what is happening, not just looking at the fair value gap and then in your heart you're like, now it's time I take this trade. No, like I told you, we need to put a puzzle together, put things together, so that we come up with a conclusive way on how to read this price or the markets. Okay, all right. So let's look at this. Fair value gap fill. Okay, an FVG can be partially filled, fully filled, uh, unfilled. Let's take a look at these examples here. All right. What happens here? Price partially taps into this fair value gap. We have 1, 2, 3 candles here, and what happens? Price goes up, returns back, and then taps into it partially, and then we continue higher. Price enters the fair value gap, but does not completely trade through it. You can see here. It taps into it and then continues higher. 1, 2, 3 candle. This is the bullish case. And then what happens? Price comes, taps into it partly, and then it continues its direction. Let's look at fully filled. So price comes here. We can see we don't have any fair value gap because there's no space between 3 candles. But here, when you actually have 1, 2, 3, so we have this space between the candle and the first candle here and the third candle in the row, which we call the fair value gap, like I said. Now what happens? Price comes and it fully taps into the fair value gap and then trips or drops down. It reacts and then now moves away from it. So you can see it is fully filled, okay, but here it tapped in partially. Okay, so you need to have that knowledge. That's why I normally tell people, what is the logic? Don't cram. Don't cram. Just understand. Because when you understand, that's when you create a concept or a logic behind every trade you take. But if you cram, you want to see patterns, you are not trading any pattern here. We are reading price to build context and narrative so that you can take a trade that has meaning. Okay? Unfilled, price never returns to it. Don't assume every fair value gap needs to be filled. That's a better mindset. Let's look at this one here. 1, 2, 3. Fair value gap. Price goes up, does not come back to it. Again, 1, 2, 3 candles. What happens? We create a fair value gap between 1, 2, 3 candles. Price never comes back, it continues. So not all fair value gaps will be filled. That's a good mindset you're supposed to keep at the back of your mind. Not all fair value gaps must be filled. All right. So let's look at some advanced, but just in a bit of something advanced concept of this. Well, let's look at consequent encroachment. Okay. I think let's not go into this, but let's look at it here. Let's look at it here. Are you seeing this line, this dotted line here? I'll show you how to put it on your chart. All right. You should mark like a fair value. This your fair value gap has a 50% of it. Okay. So that 50% is what we call the consequent encroachment. Okay. The 50% of your fair value gap. The 50% of your fair value gap is what we call the consequent encroachment. Okay. This is an important advanced concept. The 50% level of the fair value gap is always called the consequent encroachment. Okay. So if this is the your fair value gap, you want to see price enter into the 50% of it. Okay, this can be used as a point of reaction, entry refinement, measuring how deep the price has entered the fair value gap, risk management. Okay, but again, CE or consequent enrichment level, not a guaranteed reversal point. Okay, but don't mind about this so much. Yeah, like I told you here, you see, this didn't reach even 50%. This tapped into the 50% yet never returned. So focus on the context. Like I told you, we are not cramming. If you cram, you are not going to get the concept. But if you understand, you get the concept very well. Okay. All right. So fair value gap nested into another fair value gap. So sometimes you find that a fair value gap may be inside another fair value gap. For example, if you are on a higher time frame, okay, you can find a higher time frame, all right, fair value gap. Inside it, there is a lower time frame fair value gap, which I'll look at on the charts. This can be useful because the higher time frame provides the location, while the lower time frame provides an entry refinement. Okay, so the higher time will tell you price is going to react from here, then the lower time tells you price is now reacting at this point. All right. So you can see that the price creates an impulse, which is the aggressive move, which fair value gap led traces, then it continues. The fair value can act as a potential discount or entry area for a bearish trend or bullish trend, depending. Okay, we shall look at this on the charts. I just want to first create an insight about them for you guys. All right. Let's now look at another concept called the inverse fair value gap or the IFVG. So now we get to the important part. An FVG is essentially an IFVG is essentially an FVG that has been invalidated. Okay, and then becomes relevant from the opposite side. Simple idea. Just how to identify an FVG, saying okay, um, this was a fair value gap. 1, 2, 3. We have a fair value gap here. All right. Now, what happens is this candle is this candle here. This candle is this candle here. This candle is the same as this candle. What happened? We know we are expecting price to come back into this candle and then go up. But what happens? Price comes into this candle, reacts a bit, and then this next candle comes and closes below this space here. This our fair value gap. So now this space changes. This space here changes from being a fair value gap to what, to an inverse fair value gap or IFVG, because price has closed, a candle has closed below it. The moment a candle closes below or above your fair value gap, it becomes an IFVG, inverse fair value gap. It is telling you that now price is no longer speaking the direction where you anticipate it to go, but it is now trying to reverse into the direction that it was coming from. Okay, before previously, or we are changing direction. Literally, IFVG tell you that is now a point of reversal. This is for a bearish scenario. Okay. Okay, in this case, price is telling us that it is now more bearish than bullish. Here we were bullish, and now when you create this price is telling us we are now bearish. I told you, play this lesson as many times as possible and on the charts. We shall go through the charts, and then you also will need to go through them, try to identify these things. Let's go another example of a bearish FVG changing to bullish IFVG. 1, 2, 3. What happens? The space between the first candle and the third candle here, giving us an FVG. So we anticipate that candle should come and touch into this and then continue into the lower side. But what happens? This candle is the same as this, but these are bolded out. This candle is the same as this, and this candle is the same as this. So what happens? Price comes and prints for us this IFVG here. But what happens? We see price coming into it, taps almost, feeling almost all of it, reacts, closes inside. This candle again reacts, and then we see a candle closing above it. We see a candle closing above it. Now this is no longer an FVG, it's now an IFVG. Okay, it's no longer an FVG, it is an IFVG because price has inversed it. It has closed above it. Price must close above it, not inside it, above it. We must close above it. Then we know now we are no longer into the bearish market. Price is signaling to us that the buyers are more aggressive in the market than sellers. Hope you get my point. Okay. The most important IFVG concept, don't memorize IFVG. Don't memorize that fair value gap becomes inverse fair value gap when price touches. No, that's incorrect. Okay. The important event is invalidation. Say that the moment if a fair value gap is invalidated or price closes above it, it becomes an IFVG, inverse fair value gap. Inverse. Okay, it has been inversed. Okay, it's no longer now in its original state. It has been inversed. Okay, so price is a to potential react from the area. IFVG, price has demonstrated. So now let's look at this. Understand this. Very key, very key, very key, very key. I don't even know how I can bold this for you guys. Very clear. Let me first try to give it even a color here in red. Exactly. So we are saying, even this, let me try to give the color in red here. Very key, very key, very key. FVG, you say price is expected to react from this area. For fair value gap, you say price is expected to react from this area for fair value gap. And for inverse fair value gaps or the IFVG, price has demonstrated that the original expectation has failed. So price will not react from this area to give you your direction that you are anticipated before the continuation. That failure itself gives us information. All right. Therefore, it is telling us that the price is going to reverse. Okay. Therefore, an IFVG can be more informative than the original FVG because the market has already shown you that the original imbalance failed. We have failed to balance it, but we have disrespected it. Very key, very important. FVG, you expect a reaction from that area. IFVG, price has failed to demonstrate your expectation. Yeah. So we are saying fair value gap versus inverse fair value gap. All right, let's look at here. FVG, original imbalance. IFVG, or the inverse fair value gap, failed or inverted imbalance. Created by displacement, okay? Created after the FVG has been invalidated. Can act as support or resistance. You want to buy or sell from here. often acts as the opposite to the original expectation. That means you're not going to buy or sell. Literally, it can help you protect you from the market because you want to see it getting in. You want price to react from the fair value, but the moment you see it not reacting from there, then you know I'm not going to take this trade. It's not worth it. The risk. Price is going against me before even you place the trade. Based on original direction move, this one now, the original direction move, based on failure or plus reversal, or like I told you, IFVG helps you to know that price is going to reverse. Fresh information contains information about failure. That's it. That's the difference. All right. So you can just look at it again and try to identify some few things here and there as we continue. So IFVG plus market structure, and IFVG becomes more interesting when it aligns with structure shift. For example, liquidity was taken, displacement, and a fair value gap was created. Price returns to the fair value gap and breaks the fair value gap. Okay. Then market shifts structure. You see now market shifting structure. Then now you will see that an FVG has formed. You wait for price now to retest continuation, and then you will enter or react from there. Okay, this is much stronger narrative than just saying it is an FVG. This is a good narrative here. You want to build other than just seeing an inverse fair value gap and then you take it as inverse. Now I'm going to enter on the second candle now. All right. Fair value gap and premium and discount. All right. You can combine fair value gap with the dealing range. For a bullish setup, traders often prefer buying in a discount, and for bearish setups, traders often prefer selling in premium. Simple model: previous high, previous low. Okay. Then the range between the previous high and the previous low, that's your dealing range. Okay. Then above the 50%, it is your premium, and below the 50% is your discount. So we shall look at this when you look at the Fibonacci tool in our lesson on mastering the Fibonacci tool and air standard deviation. So we shall look at this more in the coming lesson. Just stay tuned, like and subscribe. We shall go deep into this. Right? A bullish fair value gap located in discount can be more attractive than identical fair value gap located in the premium. But don't treat premium or discount as standalone signals. Like I told you, we combine everything. We combine everything to come up with a clear narrative. Okay, combine everything, come up with a clear narrative so that we can take trades that have meaning and logic. Okay, fair value gap quality checklist. How you check a fair value gap quality checklist? Was there a stronger displacement? Is there FVG clearly visible? Did it form during a meaningful price movement? Okay. Context: was liquidity taken? Is it aligning with higher time frame direction? Is it in an important structure? Is it in a logical premium or discount area? So this is when it is forming, and this is the context behind it. Very important. Okay, return. How did the price return to the fair value gap? Did the price approach slowly or aggressively? Okay, did the fair value gap hold or fail? These are things you need to ask yourself before even placing a trade. Okay. Did the structure shift? Did another FVG form? Is there an IFVG after the failure? So these are things you try to go through before even placing that trade. Okay. Let's look at the IFVG quality checklist here. Was there a legitimate FVG first? Like I told you, IFVG is when the FVG fails. That's when you call it IFVG. Did the price actually invalidate it? Was the invalidation strong or weak? Did the structure support the flip FVG? Did the price retest the IFVG? Is there liquidity behind or in front of the setup. Does the higher time frame agree? The key is to confirm all this before placing a trade. Traders are patient people. That's why the market takes money from impatient people to the patient people. Common mistakes people do. They mark every fair value gap. Just become full of meaningless boxes. Okay? Everything you see, you mark. Everything you see, you mark. No. The market can make a million FVGs, but may not respect all of them. All right? A bullish fair value gap does not guarantee bullish continuation because it can change into an IFVG. Selling every bearish fair value gap, same problem, because not every bearish fair value gap is going to hold. Some may turn into IFVG. Calling every broken FVG an IFVG. The break needs to be meaningful. Like I told you, ask yourself here, this marks a good fair value and a good IFVG. Okay, this is the checklist for IFVG. So don't call everything that has been flipped an IFVG that is meaningful. Ignoring displacement, that is aggressive moves within the market that create the imbalance. Ignoring higher time frame fair value gaps, a beautiful 1 minute fair value gap can be completely irrelevant against the strong high time frame order flow. So in simple terms, entering simply because price touched the box, okay, is not bad. It must accompany it with logic and main things. Advanced mental state model, okay? Instead of thinking FVG equals to buy or sell, think FVG tells me where aggressive price delivery left an imbalance. Then ask what happened before it, what happened after it, did the market respect or invalidate it? After it fails, can that failed imbalance now become an FVG? This way, you are reading price behavior, not just drawing boxes. Okay. One last minute rule or one line. We are saying fair value gap displacement leaves an imbalance. Okay. Bullish fair value gap candles three low. Okay, is greater than candle one high. Bearish fair value gap candle three's high is greater than candle one's low. CE is the 50% of the fair value gap, and IFVG is a fair value gap that has been flipped or inversed. Strong fair value gap should be created after liquidity has been swept, displacement, to create a structural shift, and then match with the context. Strong inverse fair value gap, there must be a fair value gap with meaningful invalidation, then structural shift, retest, and then we continue. The golden rule is don't trade the box, don't trade the fair value gap, trade the story behind it. Okay, so now let's hop onto the charts and then look at this thing on the charts and we try to identify them as we go into it. All right, so guys, now let's go through the chart work and try to identify the fair value gaps and the inverse fair value gaps. I'm going to start from here. I'm going to start from where? I'm going to start from here. I'm going to start from here. So let's try to go through them, identifying them together. So what are we seeing? You can see prices coming down, 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 down. What happens? So we know this is what? Uh, if you try to zoom in, you can show that here, this is a lower high, lower low, lower high, lower low, lower high, lower low, all right? From the market structure lesson. So what happens? We print here a fair value gap here, okay? Price creates that fair value gap, which never turns back into, and is okay. We say not a fair value gap price will come into it, okay? So price again comes, all right? It's just this area, comes lower, all right? it prints for you here another fair value gap here. Okay, and what happens, we see price coming because as you can see, let me try to make this maybe a bit bold very well so that you can see it clearly. Yeah. So we have one, two, three candles. So like I told you, how we mark our fair value gap. We mark the wick of this. So you can see we mark the top wick of the lower candle for a bullish scenario and the lower wick of the third candle. Okay. So what happens now? This is a fair value gap here. We know this is a fair value gap. Okay. This is a fair value gap. So now price comes, taps into it, it reacts. Okay. But then what happens? We are expecting now price continue higher. What happens? Price comes and again trades below it. Now let's try to look at this context here. In simple terms, you would say, okay, did we break above this? No. Okay. But what happened? We swept the liquidity here. And structure what's the order flow? We are in a bearish market. So not until this high is taken now that printed this low, okay, you cannot consider this a break of market structure here. These are internal market structures on the 5 minute or 1 minute there. But now, because it has not taken out to this high that printed the low, we don't consider this as a break of market structure. But then we consider this happening, okay, in a key zone, which is the premium zone, we see it happening in the premium zone. You see, this is above 50%. Below here, you said we sell about the 50%, which is the premium zone, and buy in the discount zone, which is below the 50%. Okay. So price sweeps out liquidity. We are in a bearish market. We created a fair value gap, which got invalidated here by this candle. Stronger displacement, bearish market, sweep of liquidity. Okay. We sweep liquidity, respecting this liquidity block here. We swap this liquidity, respecting a liquidity block here. Okay, right? So this high took our liquidity. We displaced, aligning with the structure, creating, inversing this fair value gap and making it an inverse fair value gap. So now with this candle flipped this fair value gap, you see stronger displacement here. Price pushes low. All right. So let's look for another one. So now we have a lower low and we have a lower high and a lower low, right? So we expect now price to continue pushing higher, pushing lower, I mean to say. Now let's look at this fair value gap here, like I told you. Again, what are we seeing here? Price prints 1, 2, 3 candles. What happens? Okay, here we are calling it a fair value gap as long as it has not yet been flipped. Let me try to make this black and a bit bigger. Give it 18. Yes, and black. So this, as long as it has not yet been inversed, we are going to call it a fair value gap. But what happens now when price inverses it, it becomes a flipped zone. Now it's no longer a fair value gap, but an inverse fair value gap. And now we use that when price inverses this fair value gap, it taps into it and continues higher. Okay. Now look at this point here. What happens? This was a high. We said we are going to confirm break of structure when the high, which is the mother of this low, has been taken. All right. All these moves here stem from this high here. So what happens here? We can see price closing above it. So now this confirms to us that this is a break of structure. All right, this is a break of market structure here at this point. Break of structure. This is a break of structure at this point. So we break structure above this area here. What happens? We create a fair value gap. You see, we create a fair value gap. After flipping this fair value gap that we didn't touch in initially. All right. So we have two things here. We flipped the fair value gap here and it became the inverse fair value gap. You see, your price did not touch into it after here, after when I told you that. Price didn't touch into it. But what happens here? Price continues playing lower to accumulate. Okay, we manipulate a little bit lower. And then what happens? Price inverses it. It closes, this candle closes above it. This candle displaces, creating two things: inverse fair value gap and break of structure. This now becomes very meaningful and very important. Now, this displacement creates for us an FVG here, or fair value gap at this point. Creates for us a fair value gap here. What happens when it creates this fair value gap? Look at what happens. Price comes and taps into this fair value gap. Now, if you remember our lesson on CISD, what happens? We tap into this, create this fair value gap which we created here, the space between this one candle, two, and the third candle. Okay, let's try. Let me try to zoom in very well for you guys. I mean zoom out so that you see. So, what do we have here? This candle and this candle. So, we have this space between this candle and this candle. Price displaces above it, breaking structure from the left and creating a fair value gap. Now, what happens? Price, we said we have partial fill and fully fill and unfill. So price comes back here, taps into it, retests the fair value gap here, fills it, and now we are continuing. So now, like I told you, if you remember our lessons on CISD, what do we have here? Right? Price internally on lower time frame, it has printed like lied sellers that's going to sell again, but then trapping what? Trapping them here. This is a trap here for sellers. People want to sell again from here who are smart money concept traders and other traders. They will say, okay, this is an area of resistance. This we shall look at them during the liquidity lesson. So we say this is a resistance. But what happens? What happens? Because they don't understand structure from the beginning, all right, our price has been moving. They are considering this as a resistance. But no, let me not go into that. Let's focus on this. Let's focus on this, guys. Let's focus on this. Okay, so now price trapped sellers that it is selling, leaving here a high, which now when we break, it becomes a CISD, okay, on lower time frame, price changing from internal sells to bullish. Now on the break of this, we enter our long, because now what we have the narrative. Price broke aggressively. That's one. We invest a fair value gap. Two, we broke structure. We have break of structure, displacement, inverse fair value gap. We have fair value gap. Now we combine it again with the CISD. We have liquidity. We have inducement. All are into play. So the narrative here makes sense. So someone now can say, okay, I'm going to use this, have the break of this. Now, because it's a CISD, and now the narrative makes sense. Okay, stop loss below the fair value gap. Now you can target higher areas. You can target higher areas, and you can see price continued now, creating shifted now completely here, creating more higher high, higher high, higher low, higher high. Okay, then this is internal structure. This is a choppy market. This one here, we have a choppy market here, which gets now which we manipulate later. and again price manipulates more, right? Printing this low here, right? What again are we seeing here? So we are saying fair value gaps in this area. If you remember, in the choppy market, we don't consider them. Look, because they are not meaningful, they don't have clear meaning. Look at this fair value gap. You cannot consider this fair value gap because of the price, how it is performing here. It is too choppy. It is too choppy market. And there is no clear reason. There is no sweep of liquidity that created the displacement. You can see the high is still intact here. So there is nothing. Okay. That's why you can see price again comes and pierces through it. So if you entered here, you could easily be taken out because you are buying in an area where you're not supposed to be buying. The market is choppy. Are we together? Now let's look at this. When you look at our lesson of liquidity, you'll understand that this is liquidity here. This is liquidity resting here. Okay? It's liquidity resting here. So what happens is price does what? Takes it out. Okay, so what do you want to see? What you want to see, you want to see the high that is responsible for this low, which is this, stems from here. This is the high that is responsible for the low. So price puts in what we call a CISD here. So we put in a CISD. Okay, so what happens now, we can see that this is the high that was responsible for this low. Now uh, so the high that was responsible for the low, okay, this was the high that printed this low. So now this low here comes and prints this high. So now the moment now we take out this high that printed this low, this is a break of structure here. Okay, now when we break this structure here, now we know this law. So if now we break this law, we break this high that printed the low. We don't want to see price trading again below this low here. But now we should look for key areas around this zone here. Okay, around this key zone here. Now what do we have here? We have a fair value gap here, which was retested. Okay, price retested it. Okay, so, but we, like I said, we don't want to see price doing what? Price taking out this low. This is our kilo. Now, from here, we have a low and we have this high here. So we said when this side traces, we said we don't want to see it taking out this low. Now what happens? Price retraces. Okay, this was the fair value gap, though it didn't get in. It didn't. So this is a fair value gap. We see it, price tapped into it, continued higher, right? So what happens when price reaches this point? It retraces again. Now, you don't want to be buying again here. Okay, so now when price retraces, it comes back into this area, respecting this low. So you don't want now to say, okay, price has just tapped here, then I buy. No, you want now price on the lower time frame giving you a reason to buy. You want price to give you a reason to buy. Now what has happened? Let's now read the narrative here. Let's try to understand the context. Price was initially bearish. What happened? We print this low, induce sellers, take them out here, come back, induce buyers. We induce buyers, smart money buyers here, right? What happens now? We also take them out. Now, after taking them out, what happens? Price displaces because now its work has been done. All right, it has been done. No longer has any other work to do. Right? People were buying from around this area. Let me mark it. People are buying here. Here they were buying, and their stop losses were below. So what happens? We price comes and sweeps them out. Now, when it sweeps them out, it gives you what? How do we call this? If you remember, okay, that one is your homework. Price gives you this on the lower time frame. We call it a CISD again, internal CISD. So price again gives you an internal CISD, right? Because this was a short-term sell here. Gives you CISD, creating displacement, push of liquidity. We displace higher, align with higher time frame, order flow, which is bullish. Price, what happens? Creates a fair value gap here. What happens when price taps into the fair value gap? Boom, it goes higher. It goes higher. So you put your entry here, stop loss below, and we are good to go. This fair value gap has meaning, it has more context, all right, than this one. Now, let me show you another fair value gap. We have this fair value gap here. Why doesn't one have context? Because which liquidity has been swept here? Nothing. Which break of structure has been done here? Nothing. Okay. So what happens? Price pushes again higher. Now we have a low here. Now, if we look at on our lesson on liquidity, we shall understand this low now becomes an area of liquidity. It's no longer now a varied low because price reacted from it. So now price in the future it will come and trade below it. Then it goes high again. So what happens? Price goes higher. With a trace, we create internal range, liquidity here, mm, internal range liquidity here, price pushes, pushes, pushes. All right. But on that way, look at what's happening. Okay. Fair value gap here, price taps into it, it drops. All right. But now, if you understand the context on the higher time frame, when we look at liquidity, you'll understand that now we start a build-up phase of liquidity here. Okay. Now, and we are in a bullish market on the higher time frame. That means you want to be looking for more of buys and maybe scalp sales after mastering everything. So what happens? We are building, 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 building. Here, I'm not interested in anything for my case. What happens again now? All right. We take out this high, show the sell here that was called, all right? But I want the focus to be here. I don't want to focus on anything. We print this low, okay? We printed this low here, this low from the left. What happened when price comes, it takes it out, gives you again a fair value gap. Gives you again a fair value gap here. When price taps into it, you buy and you hold, okay? And now, this is your next draw. This is the liquidity here resting here. So we expect price now to come back and take this high. Now you see that when it happens with the context, it makes sense because now we have liquidity swept. Higher time frame we are bullish. Okay. Higher time frame we are bullish. As you can see, I've been taking a buys. Higher time frame we are bullish. And now we said this low, the low wouldn't hold. The low wouldn't hold. And it did not hold. It is swept liquidity in line with narrative, which is or context, which is the higher time frame, and the bullish fair value gap makes sense. Okay, it makes sense, it all the sense. So that is it, guys. You can go back and watch this video. Make sure to make notes and ask where you don't understand. For those who are in our WhatsApp group, we shall be doing this session live and trying to go through it again to revise it together on Sunday I love you. Until we meet again. Bye for now. Take care. Rewatch this session as many times as possible. Let's wait and see. Bye.